First of all, let me say we celebrated our 5-year anniversary here at City Different Investments last week. Those of you that were able to join us for the fun party, we appreciated having you out here. And any of you that are on live or the replay that are clients, thank you so much in helping us get here to 5 years. Joel Van Essen runs our small business acquisition franchise. He'll close us out with updates that he's seeing in that marketplace. But off the top, instead of going to Chris and Shweta on our fixed income team first, I'm really excited to introduce Rolf Kelly. Rolf worked with us for 11 years at Thornburg Investment Management before going to a competitor and running a strategy team for that competitor for 8 years. And as of January 1st, he's back in the band. So with that, Rolf, I wonder if you'd just briefly touch on why City Different, and then briefly on your philosophy or approach, the strategies that you'll be running here.
Yeah, thanks, Connor. I think the why City Different question is, I see a culture rapidly developing or already developed here that reminds me of the best place that I ever worked. And so that's really what it comes down to. And I think when I was having discussions in my reflection period, my Ralph Waldo Emerson time at the pond, thinking about what I want to do with the next chapter of my life, I talked to somebody who talked about a Venn diagram where you have a circle over here of people that actually create alpha and outperform. And we know that's pretty small. It's like 20% of managers are in that circle on the Venn diagram. And then you have another circle over here, which is your jerks, and the intersection of nice people with outperformance is very, very small. So us nice people that produce alpha, we need to stick together and band together. And that's what this firm is for me.
Just briefly on the strategies that you're going to run, and very brief on your philosophy.
Yeah, so philosophy and approach is concentrated best ideas investing. So there's 2 products I've honed in on, and that's an international of 20 to 30 stocks, and then a concentrated version of that around 10 to 15 positions. Its basis is on screening out most everything. So there's a very short wish list that I have of, call it, less than 100 companies that I'm tracking. And these are businesses that have passed through the moat test, or the no moat businesses got screened out. The conglomerates got screened out. Any accounting red flags or management red flags, like related party transactions or anything like that, gets screened out. Any kind of serious leverage gets screened out. So you end up with a pretty short list. And then I'm looking for a moat, and ideally a strengthening moat or competitive advantage around that business. I'm looking for above average growth rates within that protected garden wall of the business. I'm looking for management teams with ownership mentality, and then a reasonable valuation. And that's basically what I'm doing.
That's perfect. That's great. I'm excited about the strategies Rolf is launching here at City Different. I'm also excited about the fact that he and Rob and Vin and now John know each other. They respect each other. Vin and Rolf have talked ideas for years, even at different firms. So I'm also excited about what Rolf brings to CDI in terms of strengthening our equity research bench. Thanks, Rolf. Shweta and Chris, we have a new Fed chair. Very exciting news in the bond world. Can you give us an update on what you guys are seeing, Shweta?
Sure. Yes, that we do, Connor. So the big opener from the fixed income team is that the news of Kevin Warsh as the new Fed chair. Now, the market has reacted to it pretty in a predictable fashion, with short rates getting lower and longer rates getting steeper or higher. There is skepticism that policy shift may not occur until July. Despite Warsh's more dovish recent tone, we still expect rates to be somewhat in this steady range this year as inflation remains above the Federal Reserve's target. Warsh's influence hinges on building an FOMC consensus. Pushing cuts or balance sheet reduction will be difficult for him amid internal diversity and independence concern of the Fed. We've seen resistance come in terms of, for example, Senate resistance tied to DOJ investigation could slow approval for Warsh and prolonging uncertainty around Powell and the Fed's leadership. We already saw Republican Senator Tom Tillis of North Carolina support Warsh, but he refused to proceed with confirmation due to ongoing Justice Department's investigation with the Fed officials, and this could delay his approval. Finally, when the Fed did meet 2 weeks ago, the messaging is loud and clear that the Fed is on hold and it's not paused. Fed officials see rates as appropriate and are waiting for data to justify any move up or down. And speaking of data, Chris is going to dig a little bit deeper into this.
Thanks, Shweta. So the Fed still has two mandates. It has to worry about unemployment and it has to worry about inflation. Let's look first at the employment side. Employment has been slowing, but I would argue that it is not light your hair on fire slowing. Last non-farm payrolls number was 50,000, well within the range that Chair Powell has stated that you need to maintain current unemployment levels, and that range is 40 to 50,000. We are now in another government shutdown, although a shorter one, but it has caused some data to be delayed, most notably non-farm payrolls and CPI. So, as the saying goes, in the land of the blind, a one-eyed person is either king or queen. So the focus today was on Challenger Gray and Christmas layoff numbers, and that was up 118% over the last year. The problem is that number has a high degree of variability, so it's still within the fair range. The other mandate the Fed has is inflation. And what is the driver of inflation? Milton Friedman told us it is always a monetary phenomenon. That means more money chasing too few goods. If you measure money through M2, M2 has continued to grow. It's expanding. And if you look at the time series, it's expanding at almost a 2 standard deviation event. So that's significant. And not only is M2 increasing, but velocity of M2 is increasing. So as Ben Bernanke once said, if I drop $1 million in your backyard and you put it in your basement, that's not inflationary. You have to use it. And people are using M2 right now. So as Shweta said, we are maintaining our neutral view of duration and overweighting the front end of the curve, which Shweta will touch on now.
Thanks, Chris. And, despite of what the equity market and headline risk are showing, the fixed income asset class remains resilient for all the criticism that Treasuries have gotten with regards to headline volatility. They're still holding out to be a better safe haven than silver or Bitcoin. And you can see that trend play out in both credit and municipal markets. Both munis and IG credit are experiencing healthy issuance trend in 2025 and are experienced a healthy issuance trend in 2025 and are expected to continue in 2026 with trailing issuance of 550 billion in munis and $1.6 trillion in IG. The credit story is the same across both asset classes. 10-year credit spreads is at 97 basis points in corporate versus historical average of 156 basis points and 96 basis point in 10-year munis versus historical average of 168 basis points. Finally, to recap our fixed income messaging for this year, we are positioned at midpoint neutral duration, overweight in 1 to 5 year part of the curve, unless the metrics and the risk vectors that we track tell us otherwise. Thank you.
Great. Thank you, Shweta and Chris. Reminder for those that don't know, we've got a fixed income weekly that goes out on Mondays. So written piece, feel free to subscribe on our website. Chris and Shweta are recording videos around that weekly to give you the highlights if you're interested. And this month we did a fixed income dedicated webinar. So keep an eye out for those in the future too, a little bit longer form. if you're not getting enough Chris and Shweta on this call, we got lots more options for more exposure. Hey, Vin, wonder if you touch on continuing currency weakness or whatever else you're seeing in global equity market.
Yeah, thanks, Connor. We just wrapped 2025 for the year. We put our report on the website last week. Please tune into that, and you'll notice that we did benefit from our international investments, which are partly affected by the currency dynamics. As we've talked about a few times now recently, the dollar has shown a weakening tendency for some time. In fact, last week the dollar index was at a 4-year low, and President Trump indicated his approval in Iowa. He was asked about it directly last week and said, the dollar's doing great, and the policies that we have in place that have produced this weakening trend, are good for our exports, good for our manufacturing base. They do make our imports more expensive in turn, but there's beneficial elements for some of our investments as a global portfolio. And so, please check out some of those investments that we've highlighted on our website. We also, in addition to the letter, we just profiled a fairly recent investment on our site. You can see that as well, another international company, and there's a synopsis of that new investment for us. Should be at the intersection of a number of favorable trends, including the currency, but especially from a bottom up perspective, we're still microeconomic oriented, looking at stocks one by one, and we think this company fairly attractive through those lenses that we use. And of course, there's an AI angle as well. This is 2026, and AI is your top of mind for a lot of us as analysts. So we try to be well positioned for that. And if the dollar trend continues, that would be fine for us in the City Different global portfolios.
Okay, Rob McDonald, give us a view into domestic. And I think speaking of AI, you were going to talk a little bit about how AI is impacting our investments.
Yeah, thanks, Connor. So AI is super interesting. We're thinking a lot about it. Moments of uncertainty usually create opportunities, but you also have to be careful. Like it's the things in flux, and you don't want to be on the wrong foot. So I was thinking about this, and in the current environment, actually reminds me of the commodity markets. In the oil industry, they're just saying that nobody knows nothing. Instead of referring to the price of oil, because there's tons of smart parties out there. There's governments, there's OPEC, there's international or global oil companies, these institutional trade desks, and they're all very smart and have lots of knowledge and lots of info. But there's just so many unknowables. There's the economy, there's geopolitics. What's OPEC's behavior going to be, and the weather and trader sentiment. So all these things, I think they make it so that in the end, nobody knows. I kind of think there's parallels to AI there, where we know that AI is going to change things. It's going to have big impacts, but the specifics, it's going to be tough. This week, we're struggling with software, which used to be thought of as this great business where you build it once and then you can replicate it at zero marginal cost. And it's been, for decades, has been great. And now there's a question of what's the value of software if AI can replicate part of it very quickly. So that's a really interesting question that the markets, especially this week's, been asking. There's room for lots of thinking on this. Which companies will be affected, and which ones will be affected a lot, which ones will be affected less so. And so that's, for us, it seems like a really good use of time and something to think about. So just sort of wrapping it up, like the lessons from the oil industry that can be applied to AI. It's no one has an information advantage. Like nobody knows nothing about like what's exactly going to happen. No one in Silicon Valley has the crystal ball. Don't overestimate your abilities to predict the future. Like it's kind of unknown, and look for a few spots where you think the market might be either overreacting or underreacting. So that's sort of what we're doing in domestic land right now.
Thank you, Rob. Joel again heads our small business acquisition franchise here at City Different Investments. I do want to be clear, especially as we go into Q&A. This isn't the right venue, I don't think, to talk about specific investments in that practice for us. I think Joel's more going to be addressing big picture, what he's seeing in the environment. And then always reach out to Joel or anyone else on the rest of the team if you're an investor in any of our investments and you've got questions.
Thanks, Connor. So I want to just talk briefly about what I see in kind of the broader private equity market in general, but more specifically in the lowest end of the lower middle market where we really operate with this small business acquisition strategy. In 2025, total transaction volume was fairly flat compared to 2024. Deal value was up slightly, about 3%. These government shutdowns have a huge impact on deal making in this small business world. Many buyers of small businesses rely on SBA financing, SBA 7A and 504 loans specifically. And so when the government shutdown happened late last year, and earlier this year as well, it was estimated there was about $5.5 billion of backlog demand for small business loans that I anticipate will be dragged forward into 2026. So I do expect deal activity to pick up early in the year and then probably slow down with the election cycle and people kind of waiting and see what's going on there. Specifically, the industries that were targeted the most were service businesses. So financial service companies, transaction volume was up 38% year over year. Technology service companies were up about 17% year over year. I think that's driven by a lot of groups rolling up these service providers. As we've already talked about AI, I think that's a core part of their thesis is using AI to kind of streamline the back office. And there's also some insulation there, I think, with these domestic service providers from, trade exposure or international exposure. So overall, last year was a little bit of a slow year, not much growth compared to 2024. I do expect a little bit of growth in 2026 and an increase in deal volume, but a lot could change depending on what happens in November here.
That's great, Joel. Thank you. For those listening, Joel's got his finger on the pulse of a lot of what's going on in the private markets, especially independent sponsors. So feel free to use him and us as a resource as you're thinking about what to do with client assets in those areas. He's got a lot of information and knowledge. All right, we're going to try something new. We have a hand raised. Bob, I don't know if your hand raise is on purpose or not, but we've let you in.
Well, great. This is for Chris and Sweta. Is it not positive that in the medium to long term that the Fed is finally going to shrink its balance sheet and quit buying all this government paper?
Well, Kevin Warsh has said it. He wants to shrink the balance sheet. And
Right.
if he does that, that's going to be somewhat restrictive on interest rates, and that is going to be going against the person who nominated him for the position. It's not going to help ease the interest rate environment.
But just to stop manipulating by doing that, I would think it would be a long-term positive, notwithstanding who his boss is in the future or who's in office.
And historically, Kevin Warsh has taken that stand of a lighter balance sheet. So this will be a test. I think that's what the market and investors will look at him for. How does he change his stance now that he's the Fed chair? And how does that influence his policy making? The good thing is that the Fed does make policy via consensus. So I think the answer to this is we have to wait until July to see how this plays out.
Okay, we have a question on the Q&A forum, also for Chris and Shweta. The Fed indicated that they are willing to let inflation run and are concentrating on the employment numbers. How does that influence your investment decisions about the yield?
If they're going to be trading on the employment numbers and they're assuming that unemployment is going to increase, that would put more pressure on the short end of the yield curve, and it would help our overweight to the 1 to 5 year or to the shorter ranges of our SMA's tactical positioning.
And my quick 10-second answer to this is, so employment is in uncharted water because AI and wage stagnation, productivity, what have you. This is the first time that we are seeing this new entrant in the market and how it it is impacting employment, as is the Fed. All of last year with the rate cutting cycle, employment had eclipsed inflation and the Fed was boosting the economy with regards to the rate cuts to help out with employment. However, this is uncharted territory. And I think at least for the first quarter of this year, employment definitely does eclipse inflation.
I mean, the consumer is feeling very grumpy right now. If you look at the number of jobs per unemployed person, it's about 1.1, which is extremely low. Consumer confidence is low. From an inflation standpoint, the American worker is barely keeping up with inflation at this point in time. I think the last numbers coming out, we had CPI month over month at 0.3%, and
Oh, he's getting the glasses on. Look out.
its average hourly earnings, sorry, was up to 0.25%, whereas CPI was up 0.3 versus 0.3. They're breaking even.
Okay, great. Thank you. One other last thing to add before we wrap this up. We've been doing, I think this will be relevant to teams here. We've been doing some work in terms of policy and compliance on AI implementation at City Different. And I just wanted to make sure any of the RAA clients listening in, I think, good compliance consultants have gotten a long ways along figuring out how to use and incorporate AI tools while being very careful about SEC regulation and implementation. So I was actually sort of frankly impressed with how far along our compliance consultant has gotten, our information technology service providers have gotten. I think there is more capability there sooner than you'd think. And I think that the whole industry, legal compliance side of it, is reacting to the marketplace and what's going on out there. So just one little tidbit. Okay. With that, thank you, team, for dialing in. Thanks, everybody that's been on the call. And we'll see you next time.